Welcome to this explainer. Today, we're unpacking a concept that is quite literally the foundation of banking, the yield curve. If you want to truly put your finger on the pulse of the debt markets and, ultimately, the broader economy, this is exactly where it all begins.
Okay, here's our game plan for today. We're going to break this complex topic down into 5 quick parts: the foundation of finance, anatomy of the curve, why the curve matters, yield to maturity, and finally, beyond the basics.
All right, part 1, the foundation of finance. To start us off, let's look at exactly why this topic commands so much respect on the trading floor.
Market veteran and author Murad Chaudhry actually called the yield curve his first and most intense love in finance. I mean, that is some serious passion, right? But it's because this isn't just some dry academic math. It is the absolute bedrock of the financial markets. It literally sets the baseline for the cost of money itself.
So, what is it? Simply put, the yield curve is just a snapshot. It shows us the relationship between a bond's return, its yield, and how long it takes for that bond to actually mature. It basically groups together bonds of the exact same risk class, like government bonds, and plots out what they're paying investors today across different time horizons. It tells us exactly where the market's head is at right now.
Moving right along to part 2, anatomy of the curve. Let's see how this actually builds visually.
Here's a classic example using UK gilts. You've got the maturity in years running along the bottom axis, and the yield percentage going up the side. And as you can clearly see, it generally slopes upward over time.
Now there's a totally intuitive logic to that upward slope. Think about it. If you lend someone money for 10 years instead of just 1 year, you're obviously going to demand a higher return. You absolutely need to be compensated because, well, inflation might eat away at your money over that decade, plus there's the very real risk the borrower might not even be around in 10 years. Bottom line, longer risk requires higher reward.
So you'd probably assume this curve just keeps sloping upward forever into infinity, right? But take a really close look at the far right of the timeline. Why does the slope suddenly drop off or dip at the 30-year mark? It all comes down to the realities of supply and demand. Massive institutional investors, we're talking giant pension funds, fiercely buy up that 30-year bond, known as the long bond, to match their long-term liabilities. This crazy high demand completely outstrips the available supply. And since bond prices and yields move like a seesaw in opposite directions, driving the price up inherently squashes that yield right down.
Which brings us to part 3, why the curve matters. Let's talk real-world applications.
This single curve is quite literally a Swiss Army knife for the entire financial market. It's used to set the price for brand new debt. It acts as a crystal ball for future interest rates and inflation expectations. Portfolio managers rely on it to measure returns across the maturity spectrum and to hunt for relative value, figuring out which bonds are cheap or expensive. Plus, it's absolutely essential if you want to price complex derivatives like interest rate swaps.
Okay, let's step right onto the trading floor for part 4, yield to maturity, or the YTM curve.
When a real trader fires up their Bloomberg terminal in the morning, they're looking at tools exactly like this UK gilt yield curve. Notice the 2 lines here. The solid one is for benchmark government bonds, and the dotted one is for strips. Strips are basically bonds that are broken apart so they don't pay regular interest, just a lump sum at the end. Comparing the two lets market participants analyze different pricing dynamics across the exact same time frame.
And the beauty of this tool is how we can gauge international economic health. On one side, you can see the French and German curves moving in almost perfect lockstep together, reflecting their shared Eurozone dynamics. On the other side, we've got the classic U.S. Treasury curve. Comparing these across borders gives traders incredible insight into global capital flows and relative economic strength.
But here is the massive catch. And if you take one thing away from this explainer, make it this. Yield to maturity is largely theoretical. It is an assumed yield. Why? Because to actually get that exact return, you have to assume you bought the bond exactly at par value, its original face value. And, even crazier, it assumes you magically manage to reinvest every single coupon payment you receive at that exact same constant rate. In the real world, where rates constantly fluctuate, that's practically impossible. The pros call this reinvestment risk.
Let's wrap things up with part 5, beyond the basics. Time to look at the finer nuances that separate the novices from the pros.
Because of those reinvestment risks and weird tax rules, not all yield curves are created equal. High coupon bonds trade differently because of tax quirks, like UK gilts actually being exempt from capital gains tax. So analysts might use a coupon curve in secondary markets to adjust for those distortions. On the flip side, Corporate financiers use what's called a par curve in the primary market. They use this hypothetical curve to figure out exactly what coupon a brand new bond needs to offer so investors will buy it right at its original face value. We've covered a ton of ground today, unpacking the foundation, the anatomy, and the powerful real-world applications of this essential tool. So now that you know how to read the pulse of the debt markets, the biggest question you should be asking yourself when you check the financial news tomorrow is this: what exactly is the shape of the yield curve predicting about our economy right now? Is it pointing toward massive growth, or is it flashing warning signs of a slowdown? Keep your eyes on that curve and you'll always be one step ahead.